Hi, good evening. Today's topic is about inventory measurement in in financial statements. See, at the end of the year, we need to report our ending inventory value in your financial statements, which will help us to calculate the cost of goods sold, so that we can find out gross profit, net profit. Also, the value of inventory, which is held by our company at the end of the year, is to be mentioned in the balance sheet under current assets. Therefore, it is very necessary to value our inventory at the end of the year. At the end of the year, this inventory will reflect in two places. One, in the calculation of cost of goods sold. Two, in current assets. So here, what we need to do is we need to follow some method called LCM. LCM stands for lower of cost or market. So what you need to do is here you need to find out the cost. Cost means at what price you purchased the inventory. Say for example, you purchased 1000 units of inventory at the rate of say $12. You sold 800 pieces. Now at the end of the reporting period, you have 200 units in the closing inventory. This is purchased at the rate of $12. Okay. So obviously you can know that the value of closing stock is 200 units times $12, that is $2,400. But we should apply LCM method to value this inventory to report in our financial statements. What is LCM? LCM is lower of cost or market value, which would be applied on our inventory to show the inventory value in your financial statements. Say for example, as on this date, say for example 31st December, we have 200 units. But the value of this inventory is not $12. Say for example, it is $16. You can sell it for $16. This is called market value. $16 is called as market value. You bought it, you purchased it $12. Now you can sell it $16. Using this, you need to find out lower of both. Say for example, it is not $16, it is $8. So you should compare $12 is lower or $8 is lower. So you should apply $8. The remaining amount is lost to you. This you need to present in your income statement. This $4 into 200 units. No, it is not $8, it is $16. No. So you should write 12 only. No need to disclose loss. So lower of cost or market. At the end of the year, you'll have to compare these two amounts. Lower of cost or market. Clear? Now let's see some calculations here. Now here, let us apply what we learned just now for item A. Item A, we have 400 units at the end of the year. Then compare these two prices. My cost price was 10.25, but the present market price is 9.5. 10.25, 9.5. Lower of cost or market. Lower of cost or market. So market price is lower, so I should apply this. When I multiply 400 units times 10.25, it is 4,100. 400 units times 9.5, it is 3,800. So this is the lowest value as compared with market cost price. So I have to take 3,800. Now let us apply item B. Item B, we have 120 units of stock and the cost is 22.5. Market value is 24.10. As cost is lower than the market price, therefore you'll have to apply cost price, that is 2700. See, 2700 is lower than 2892, so I apply 2700. For item C, I have 600 units in my stock, alright, which I purchased at the rate of $8, but the market price in the present prevailing market is 7.75, which is lower as compared with the cost price. Therefore, I should consider this 4650. This amount I'll consider. This amount will go to balance sheet. Then item D, well, $280, 280 units purchased at the rate of $14. Now the market price is 14.75, so I have to consider this one, 3,920. $14 times 280 units, so 3920 I should consider. I am going to show this amount in the balance sheet, but what is the total cost price I paid for? This is the cost I paid, 15,120, to buy this inventory. So this is a loss, 15,520, 15,520, which is a cost price, minus 15,070. $450 I am going to record it as loss in my financial statements. This is a loss. Okay. So this way you need to determine the ending inventory value. The concept is lower of cost or market. So far we discussed about cost and market, but we need to consider two more issues here while valuing the inventory. We know so far what is the cost price which we paid in acquisition of the stock, and what is the same stock value as on today. Today is 31st December and we want to present it in our financial reports, so we see the current market price at which we can sell it. We should also consider the cost of replacement. What happens if I buy now the same inventory? Listen carefully here. You have to be very familiar with the terminology. One, I purchased material at say $12. Two, I can sell it now at $16. Clear? Three, I can buy it back from my supplier at the rate of say $12.5. Listen carefully. This is called cost of replacement. My purchase price is different from my selling price. It is cost to replace. Cost to replace means current replacement cost. This is my cost. This is a cost to replace. So I call it as CRC. CRC. This is a fair market value. This price I can sell it for. Listen carefully, please. Cost price at which I purchased. But if at all I buy it today, the price is 12.5, which is called CRC, current replacement cost. Today I can sell my inventory at $16, but I have to pay $2 for sale commission, etc., etc., which are called selling expenses. So now my current amount is only $14 because we have some selling expenses. Selling expenses are to be removed from market value, and this is called NRV. NRV, net realizable value. At what price I purchased it? $12, no? Perfect. So so far we know what is a replacement cost, what is a ceiling, and we are now finding out the market price. Replacement cost is nothing but if I buy today, what my supplier will be charging me. If I buy the same material today, how much will I have to pay to my supplier? That is called current cost of replacement or replacement cost. Ceiling means NRV. If I sell for $16 and there will be a $2 expenses towards selling expenses like salesman commission, etc., my NRV is $14. Okay. What happens if RC is greater than ceiling? If RC is greater than ceiling, okay, my market price will be ceiling. Cost is waiting for you. Here I have the cost price. We are waiting for the market price, so that least of these two will be considered in the financial statements. So for this we are working here in three scenarios. If RC is greater than ceiling, if RC is greater than ceiling, the market price will be ceiling. Ceiling is nothing but NRV. NRV means selling price, current market price minus selling expenses. Whereas in the second case, if ceiling is greater than replacement cost and replacement cost is also greater than floor, your market price will be replacement cost. So that replacement cost amount will become your market price here, which will be then compared with the cost price. In the case of third unit, third excess, the scenario, replacement cost. If the floor is greater than replacement cost, we understand that floor is the difference between net realizable value and normal profit. Means from net realizable value, when you deduct normal profit, you will get floor. If floor is greater than the replacement cost, your market price will be floor. So you'll have to write floor here. So based on these situations, you will be either finding NRV as market price, or replacement cost as market price, or floor. Your cost is constant here. Cost is waiting for one of the items from here. Then you can compare lowest of these two. Okay, but to give the value here, you need to check these conditions. Cost is constant and waiting for the market value, which you can find from these three scenarios, and then compare LCM, lower of cost of market. We are using three different scenarios to find out the market price.